this part of the course, we'll look at reviewing accounting principles. And I'll break this section down into 12 different parts. And they are: number 1, basics; number 2, profit and loss; number 3, balance sheet; number 4, assets and liabilities; number 5, financial statements; number 6, double entry bookkeeping; number 7, cash flows; number 8, financial ratios; number 9, management and company accounts; number 10, capital and operating expenditure; number 11, audit; and number 12, insolvency. So, why do you need to know about accounting principles? All candidates may potentially set up their own practice or join their company's management team in the future. Therefore, a basic knowledge of accounting principles is required. Let's have a look at a few reasons why. For monitoring your own business accounts, for assessing your competition, for assessing the financial strength of contractors, for example in PQQs, pre-qualification questionnaires, in a tender process, or to assess initial signs of insolvency, for assessing the financial strength of potential landlords and tenants, for profits and method valuation. Remember, everything you learn in this course will gear you up to lead and be the best version of yourself. Let's go. So let's start with number 1, basics. And we'll start with the understanding of what accounting is. So, accounting is the process of recording financial transactions relating to a business. The accounting process includes summarizing, analyzing, and reporting these transactions to oversight agencies, regulators, and tax collection entities. The financial statements used in accounting are a concise summary of financial transactions over an accounting period, summarizing a company's operations, financial position, and cash flows. Regardless of the size of a business, accounting is a necessary function for decision-making, cost planning, and measurement of economic performance measurement. Another way to look at accounting is that accounting is a profession whose core responsibility is to help businesses maintain accurate and timely records of their finances. Accountants are responsible for maintaining records of a company's daily transactions and compiling those transactions into financial statements such as the balance sheet, income statement, and statement of cash flows. Accountants also provide other services such as performing periodic audits or preparing ad hoc management reports. Accounting is important for investors because the work performed by accountants is at the heart of modern financial markets. Without accounting, investors would be unable to rely on timely or accurate financial information, and companies' management would lack the transparency needed to manage risks or plan projects. Regulators also rely on accountants for critical functions such as providing auditors' opinions on companies, annual 10K filings, and in short, although accounting is sometimes overlooked, it is absolutely critical for the smooth functioning of modern finance and businesses. Accounting is one of the key functions of almost any business. It may be handled by a bookkeeper or an accountant at a small firm, or by a sizable finance department with dozens of employees at larger companies. The reports generated by various streams of accounting, such as cost accounting and managerial accounting, are invaluable in helping management make informed decisions. The financial statements that summarize a large company's operations, financial position, and cash flows over a particular period are concise and consolidated reports based on thousands of individual financial transactions. As a result, all accounting designations are the culmination of years of study and rigorous examinations combined with a minimum number of years of practical accounting experience. There are 2 important types of accounting for businesses, which are managerial accounting and cost accounting. Managerial accounting helps management teams make business decisions, while cost accounting helps business owners decide how much a product should cost. In most cases, accountants use generally accepted accounting principles, GAAP, when preparing financial statements. GAAP is a set of standards and principles designed to improve the comparability and consistency of financial reporting across industries. Its standards are based on double entry accounting, also called balancing the books, a method in which every accounting transaction is entered as both a debit and a credit in 2 separate general ledger accounts that will roll up into the balance sheet and income statement. Okay, let's have a little deeper look at accounting principles. And accounting principles are the general rules and guidelines that companies are required to follow when reporting all accountants and financial data. Whilst there is currently no universally standardized accepting accounting principles, there are various accounting frameworks which set the standard body. The most common accounting principle frameworks used are the IFRS, the UK GAAP, and the US GAAP. There are both similarities and differences between these three frameworks, where GAAP is more rule-based, whilst the IFRS is a more principle-based. The IFRS stands for the International Financial Reporting Standards Foundation and is a non-profit accounting organization. Its main objective includes the development and promotion of the International Financial Reporting Standards through the International Accounting Standards Board, which it oversees. The generally accepted accounting principles in the UK GAAP, is the body of accounting standards published by the UK's Financial Reporting Council, the FRC. The UK GAAP is the overall body of regulation established how company accounts must be prepared in the United Kingdom. And you may be asking yourself, why are generally accepted accounting principles needed? So GAAP aims to regulate and standardize accounting practices by providing a framework to ensure companies and organizations are transparent and honest in their financial reporting. Accounting principles serve as a doctrine for accountants' theory and procedures in doing their accounting systems. Accounting principles ensure that companies follow certain standards of recording how economic events should be recognized, recorded, and presented. External stakeholders, for example, investors, banks, agencies, etc., rely on these principles to trust that a company is providing accurate and relevant information in their financial statements. Okay, so we just looked at why are generally accepted accounting principles needed, but also why are accounting principles important? And the purpose of having and following accounting principles is to be able to communicate economic information in a language that is acceptable and understandable from one business to another. Companies that release their financial information to the public are required to follow these principles in preparation of their statements.